right. Well, I think we'll go ahead and get started and let people join. So I wanted to thank everyone for being here today. We're very happy to have partnered with Invesco on presenting this information. It seems like there's a lot of interest, and there will be some time for Q&A at the end. I also wanted to make sure to thank all of our annual sponsors. Our annual sponsors really help the CFA Society bring great content like this to all of our members, both via webinar and in person. So a special thank you to them. They really help us deliver good programming. And I'd like to introduce our speaker, Kyle Connor. Kyle will tell you a little bit more about himself, and he's going to share his presentation.
Great. Thanks, Shannon. Let me get this screen up and run real quick. Just want to confirm you're able to see that.
Yes, we can see your screen.
Perfect. So thanks again, Shannon, Megan, for the introduction. And again, I really appreciate the opportunity to join the CFA Minnesota to discuss tax efficient strategies in real estate today. So again, my name is Kyle Connor. I'm a real estate exchange specialist here at Invesco, and I want to just thank everyone for taking the time out of their schedule to join us today. So really my goal today is to give an overview of the 1031-721 exchange process and how to help clients that own appreciated real estate end up in a diversified portfolio of high quality real estate, all on a tax deferred basis. So we'll be discussing quite a bit of content today. And for those of you that are not familiar with the 1031-721 exchange process, just know that here at Invesco, we're here to help any way we can. And I'd be happy to conduct follow-up calls afterwards for anyone that would like to learn more about the strategy. So before we dive in, I do just want to provide a quick compliance disclaimer that neither myself nor anybody here at Invesco provides tax advice. So please make sure to consult your tax professional for anything tax specific. Now, I do want to provide a quick overview of what we're discussing today. So first, I do want to just kind of give you a broad overview and introduce Invesco Real Estate and really what makes us different and unique when it comes to investing in high quality real estate. Next, we'll go over the 1031 exchange key requirements. As many of you may know, when 1031 exchanging an investment, there are a few key areas to take note of to ensure a successful exchange. We'll then go over the Delaware Statutory Trust Program Summary, otherwise known as a DST, which is unique to the syndicated 1031-721 exchange market. And we'll discuss the client advisor benefits of this type of solution. Then we'll go over a real life example of the 1031-721 exchange, which will lead us right into a few different case studies. And then lastly, we'll have a Q&A portion at the very end. One thing I just do want to mention is that given the audience today, I will not be able to discuss anything specific to Invesco's offerings and market. But as I said, I'm happy to have follow-up conversations for we can discuss further. So to kick things off, so many of you probably know who Invesco Limited is, but may not know as much about who Invesco Real Estate is. So in regards to Invesco Limited, we have roughly 1.7 trillion in AUM, and our global asset manager, we manage an array of different types of products such as ETFs, SMAs, mutual funds, models, and private markets. When it comes to Invesco Real Estate, this is really one of Invesco's best kept secrets of the firm. Invesco Real Estate has been in the business for 40 years, and we manage roughly 87 billion in AUM, and our global firm with 600 plus employees. Not only do we invest in private real estate, but we also manage listed real assets as well. And as you can see, we invest across the risk return spectrum, and roughly 53 billion of our AUM has been focused in the core plus space by acquiring high quality real estate investments. Over that 40-year history, we've evolved quite a bit. And so since our founding in 1983, our clients have been predominantly institutions such as endowments, public and private pensions, insurance companies, and sovereign wealth funds. Some of our clients that have invested with us from the very beginning, including Texas Teachers, CalPERS, CalSTRS, And in 2019, with the Invesco acquisition of Oppenheimer Funds, MassMutual has become one of the largest supporters of our real estate business. After the acquisition in 2020, our goal is to bring our institutional capabilities to the retail channel with the launch of 3 funds that are in line with our core competencies at Invesco Real Estate. Those 3 funds include a public non-listed REIT, a private placement 1031-721 exchange program, and a private debt REIT strategy. Each of these funds serve a different purpose and has a different risk return profile, as I'll show you on this next slide. So as I stated earlier, we actively invest across the risk return spectrum from core to core plus to value add and opportunistic in debt and equity over that last 40 years. The 3 retail funds we launched are focused on the core plus debt and core plus equity respectively, with a potential target return profile of 8 to 12%. Our goal at Invesco Real Estate is to acquire high quality real estate, grow our NOI, and pass that income along to our investors. So private real estate in general terms is known for providing a natural inflation hedge and having a low correlation to traditional markets. At Invesco Real Estate, we look to invest through a lens of evolving secular themes and demand drivers focused on where tenants consume, live, innovate, and connect. For example, a primary place where we consume is at the grocery store and at restaurants. A core conviction asset class of ours is industrial cold storage. This asset class plays a crucial role in maintaining grocery stores and restaurant supply chains. I would like to provide one more example. So everybody needs a place to live, and so this is a core focus here at Invesco Real Estate. Where we live can come in different forms, such as single-family homes, apartment buildings, or manufactured housing. All of these residential assets have dedicated working groups at Invesco, and as you can see them across our various funds. As you can see on the screen, there are a lot more asset types that we invest in, but they have been all evolving through these secular themes and demand drivers behind them. So now we'll kind of get to the bulk of what we're going to be discussing today, and so specifically regarding the 1031 exchange process and some of the key requirements. So before we get into the overview of the unique process in place for a 1031-721 exchange, I do want to just give a quick background on the key requirements to consider. So Section 1031 of the Internal Revenue Code generally allows for a tax-deferred exchange of like-kind real estate held for productive use in a trade or business or for investment purposes. In other words, the IRS will allow for the potential tax deferral of real estate as long as it's used for investment purposes and it's exchanged for another like-kind investment. So what does like-kind mean? Well, like-kind is a very broad term that encompasses many types of qualifying investments. For example, rental properties, industrial properties, self-storage, multifamily, raw land, farmland, even water mineral rights and oil and gas royalties. And then, of course, Delaware statutory trusts are all like-kind investments. The IRS does not dictate that it must be like for like. So, for example, if you own a rental property, you don't have to exchange into another rental property. You can, but that is not required. As long as you exchange into one or more of the different types of like-kind investments, that will satisfy the portion of the 1031 exchange requirements. In other words, if the property is for investment or business use, it likely falls under the like-kind definition. And in the syndicated 1031 exchange market, sponsors like Invesco utilize a DST or Delaware statutory trust that holds different types of commercial real estate properties and is used as the potential replacement property for investors. The second key requirement to consider when executing a 1031 exchange is the client must exchange into a property that is equal to or greater than in value than the original relinquished property. And 100% of the proceeds must be invested into the replacement property for the potential of 100% tax deferral. In other words, if you have a client that owns an Airbnb rental that is worth $2 million, the replacement property must be at least $2 million in value, and 100% of the proceeds must be exchanged into one or multiple like-kind investments. Now, before a client sells their property, there are 2 key factors. First, they will need to engage with their CPA to make sure it makes sense to execute an exchange and defer the client's taxes. And secondly, the client must engage with a qualified intermediary, also known as a QI. The QI essentially acts as the exchange accommodator and allows for the proceeds from the sale of the relinquished property to flow to the QI instead of going to the investor. If the investor was to take the cash from the sale of the property, this would be considered taking constructive receipt of the proceeds and would nullify the ability to execute an exchange and defer their taxes. So the QI is a very important step that the investor must engage with before the property is sold. There's also a window of time that the IRS will allow you to execute an exchange once the property is sold. In other words, 1031 exchanges have a shot clock. Investors will have 45 days from the sale of the relinquished property to identify a like-kind investment, and will have 180 days from the sale of the property to close into one or more replacement properties. There are different types of rules regarding the identification process, like the 3-property rule or 200% rule, which I won't be going into too much detail today, but can also talk through that in the Q&A portion if needed. The one thing I will note is that the QI will be a great resource, and they'll be able to assist you and your clients with this portion of the exchange. However, again, here at Invesco, we're always happy to help anywhere we can with the above key requirements. So next, we'll go over the overview of the 1031-721 exchange process, specifically regarding the DST program. So now that we've discussed the key requirements to consider when executing a 1031 exchange, we can now review what a 1031-721 exchange is, or in other words, a solution that allows investors that own appreciated real estate to exchange into a diversified portfolio of high-quality real estate all on a tax-deferred basis. Before I give an overview of the program, I do want to highlight the 721 partnership contribution rules of the Internal Revenue Code. The 721 partnership contribution rules essentially state that if you contribute an investment property in exchange for partnership interest, the IRS will generally allow for tax deferral. So in this solution, sponsors combine 1031 exchanges with a 721 exchange to allow for clients to end up in a diversified REIT, all on a tax-deferred basis. One thing to mention is that the REITs do not classify as a like-kind exchange, which is why the 721 exchange is the portion that allows for tax deferral into a REIT. There are 3 unique phases in a 1031-721 DST exchange: the offering phase, the DST phase, and the fair market value option, or the UPREIT transaction on the right side. During the offering period, this is where sponsors bring to market a DST that, again, holds commercial real estate properties, and are essentially selling off fractional interest of the DST to match your client's 1031 exchange needs. Once the client executes their exchange into the DST, they will immediately start to receive the cash flows from the underlying properties. Then the investor moves into the DST phase, which will last a minimum 2 years to be compliant with the Internal Revenue Code. This phase could last roughly 2.5 years, given it may take the sponsor 6 to 9 months to close out the offering. However, as I stated, the investor does not need to wait for the offering to close before receiving the cash flows from the DST. Typically, during the DST phase, there is a quarterly cadence. So quarterly distributions, quarterly statements, quarterly appraisals, and then the annual tax form is a substitute 1099. After the minimum 2-year hold for all investors, that's where the 721 exchange, or fair market value option, or UPREIT transaction takes place. At this time, the sponsor will go out and get an independent third-party appraisal, and will have a fair market value option to acquire the properties at fair market value and convert the DST investors' interest into either operating partnership units of the REIT or cash. If the sponsor chooses to issue cash, then the client will have the ability to execute another 1031 exchange or pay the taxes on the proceeds. Most UPREIT DST sponsors typically will issue operating partnership units, otherwise known as OP units, which allows for the client to gain access to the REIT, all on a tax-deferred basis. One thing to note is that for the potential benefits of tax deferral, the sponsor must issue OP units rather than common stock of the REIT. However, the OP unit share classes are economically equivalent to the underlying common stock of the respective share class. So same NAV, distribution rate, liquidity provisions, and so forth. If the sponsor exercises the fair market value option and issues OP units to the underlying investors at this time, they will now become investors of the REIT. Typically, the cadence changes to a monthly cadence in the REIT phase. So monthly distributions, monthly NAV, monthly statements, monthly liquidity, and quarterly appraisals during both the DST phase and the REIT phase. One item to mention is that once the investor becomes an OP unit holder, this will be the last 1031 exchange the investor can execute in regards to this specific relinquished property. Also, the annual tax filing document for OP unit holders is a K1. Sponsors typically require the investors to hold the OP units for a minimum of 1 year before any partial or full liquidity, meaning this is typically an illiquid investment for roughly 3 to 3.5 years or so. However, once the client moves into the REIT, this is where the real unique benefits of a 1031-721 exchange program come into play. At this phase, the asset becomes more of a financial planning asset that financial advisors can work directly with their clients to help solve certain client needs, whether that be managing the tax liability with partial or full liquidity over a number of years, or for estate planning purposes. So as you can see here on the right side of the slide, these are quite a few of the unique benefits for a 1031-721 exchange solution. And we're going to drill down on each of these for a few minutes. The first being institutional management. The biggest takeaway here is that these types of solutions are assisting clients that are at a point in time that they no longer would like to be an active manager of real estate and would like more of a passive approach. If you have a client that is at a point in time that they are no longer wanting to manage the 3 T's of real estate, toilets, trash, and tenants, and let an institutional manager like Invesco manage their proceeds on their behalf, then this might be the right solution for them. So next is diversification. I think most of us, if not all of us on this call today, know the power of diversification, but I do want to highlight the specific benefit for this solution. The investor is typically going from a single real estate investment into potentially 1 or more real estate properties in the DST phase, and then of course into a diversified portfolio once in the REIT phase. This solution is a great way to diversify a single asset into a portfolio of real estate via a 1031-721 exchange, of course, all on a tax-deferred basis. So now the next few benefits are a bit more unique to the UPREIT structure, specifically in regards to the divisibility of the operating partnership units. So as I mentioned, these programs typically are illiquid for roughly 3 to 3.5 years. But after that time frame, the client does have the ability to seek partial or full liquidity based off the REIT's repurchase program. Typically, most sponsors' liquidity profile in the public non-listed REIT space allow for 2% of NAV per month and 5% of NAV per quarter. If the client was to sell all or a portion of their operating partnership units, this would trigger a taxable event. However, given the divisibility profile, the client can manage that tax liability over a number of years and only pay the prorated portion of what is being liquidated. So for example, if a client has a $2 million worth of operating partnership units, and if they only need $100,000 worth of liquidity, they would only pay the prorated share of taxes on that $100,000, with the rest of the taxes and gains still embedded in the REIT. Which leads us to the next benefit, which is tax planning. So as I stated, once an investor sells a portion of their OP units, it does trigger a tax liability. However, this is where it becomes a bit more of a financial planning asset where you can strategically plan your exit strategy around the tax liability. In the example I just used, a client with a $2 million property worth of, or $2 million worth of operating partnership units needing to liquidate $100,000 in the same calendar year could combine this sale with harvesting any losses from other assets and potentially mitigate the capital gains tax liability altogether. Given the primary tax we are deferring is capital gains, harvesting losses can have the potential to offset those gains without incurring a potential tax liability. Earlier in this presentation, I did mention to please discuss any tax-specific questions to your tax professional. But along those lines, another benefit of a 1031-721 exchange is the potential ability to access remaining depreciable basis through a sponsored redemption program. Now, if a client does not need any liquidity, this leads us to our last client benefit, which is estate planning. So one of the great things about real estate is that once an investor passes away, the heirs receive a step-up in basis and can sell the property without incurring a tax liability. In our program, the heirs also receive a step-up in basis, but the unique factor comes back to the divisibility of the operating partnership units and how sponsors help solve for a few issues. For example, you have a client with a single asset that is worth $2 million, and the client has three heirs, all in different life stages. If the client held the real estate property in perpetuity and passed it along to its three kids, each kid will have to agree on what they'd like to do at the time of their parents' passing. If one kid wants to sell, the other kid wants to hold, and the last kid is unsure what they'd like to do with the asset, this could create a scenario where the three kids are fighting in the wake of their parents' passing, which of course nobody wants, but does happen from time to time. They would also need to remember to get an appraisal at the time of the parents' passing in order to get a true step up in cost basis, which is likely the last thing that's on an heir's mind in the wake of someone's passing. A 1031-721 exchange DST program helps solve for both of these issues. Since the REIT strikes a monthly NAV and has quarterly appraisals, the beneficiaries will know exactly what the step up in basis is at the time of the investor's passing. Also, given the divisibility aspect of the operating partnership units, each heir will receive their divided interest in OP units and then can make their independent decisions on what they'd like to do with their shares, their share of the proceeds. Now, the last item I want to touch on is the benefits to the advisors on the call today. First off, this is a great tax deferral solution to provide some of your top high net worth or ultra high net worth clients that own appreciated real estate. It's also a great way to grow your billable AUM with sticky assets for some of your top clients. Given that the majority of the clients that decide to execute a 1031-721 exchange are typically geared towards estate planning or potential partial liquidity, this solution has a great way to monetize assets that were currently not on your financial planning book and turn a stale asset into a financial planning asset. Furthermore, if a client is utilizing this solution for estate planning purposes, these assets can be held on your book for 7 to 10 plus years, relative to some of the more traditional assets you may utilize for clients that may be traded more dynamically. Lastly, advisors utilizing this tax deferral solution for business development purposes for prospective clients have the ability to differentiate themselves in the market and bring in net new assets and new clients to grow their AUM. Instead of just being reactive to when a client opportunity presents itself, this is a way for an advisor to proactively bring in new clients via this solution. This then opens the door for advisors to offer up more of their traditional financial planning tools. So now that we've gone through the unique benefits of this solution, I would like to guide you through a real life example of a 1031-721 exchange from start to finish. So as I noted earlier, there are two very important factors before the client sells and executes a 1031 exchange, which is to engage with their CPA and to engage with a qualified intermediary. Once the client has a QI on hand, they can prep for the sale of the property. So for example, an investor has a $2 million property with a $500,000 basis, and if the client decides to sell upfront, they would incur a $1.5 million tax liability. However, the client does not want to pay that tax liability to the IRS, so they decide to execute a 1031-721 exchange. The QI has already been chosen, and so once the property is sold, the proceeds will flow to the QI, and the shot clock we mentioned earlier begins. The investor will have 45 days to identify and 180 days from the sale of the property to close into the new replacement property. One thing to note is that investors that are selling their property, that the investors are selling their property to a third-party buyer, not to the sponsor. The sponsor's DST is essentially acting as the client's replacement property to satisfy the 1031 portion of the exchange. Once the client chooses their DST replacement property, the proceeds are then wired from the QI to the DST manager, and the client receives a fractional interest of the DST. In this example, $2 million must be invested into the DST for a potential of deferring 100% of a client's taxes. After the scheduled close, the investor immediately starts to accrue and receive the quarterly cash flows from the underlying DST properties. One thing to mention is that the depreciable basis of $500,000 is carried forward to the DST and REIT phases. This allows for the investor to continue their current depreciation schedule. Before we move on, I do want to highlight the investment selection process for DST properties from the sponsor's perspective. There are a few ways sponsors can source DST properties for their program. They can source existing properties from the underlying REIT portfolio and drop them into the DST, or they can access their acquisition pipeline and drop the properties that way. Either way, typically the investment selection of DST properties are high conviction assets that the sponsor would like to hold onto post-UPREIT transaction for quite some time. Any real estate asset class that can be used for DST programs. However, the primary asset classes that are currently typically used in market are industrial properties, multifamily, self-storage, and retail, just to name a few. The cash flows will vary between sponsors depending on the underlying assets, geographical locations, and lease terms. Currently, these cash flows are ranging from 3 to 5% in the market today, but can vary over time. Lastly, each DST will have X amount of capacity in any given offering. So for example, a DST sponsor will come out with a $100 million offering and will only have $100 million worth of equity for 1031 exchange investors to take down for the specific offering. Once the offering period is closed, the goal is for the sponsor to launch a subsequent DST offering and be in market in perpetuity, which leads us to the DST phase. So once the client is in the DST phase, they will immediately start to receive the quarterly cash flow payments along with their quarterly statements. Once the offering period is closed, this will be when the 2-year hold period begins. So for example, if there was $2 million in available equity remaining in a DST offering, and our current investor took down the $2 million with his or her exchange, this client will likely be right in line with the 2-year hold period, whereas the first investor may have to hold for 2.5 years or so. During the DST phase, as I mentioned earlier, there will be quarterly appraisals, so the client will know exactly the value of their DST investment throughout the holding period. The primary goal of the DST phase is, of course, to help your clients have the ability for potential tax deferral. In addition to this, the main goals of the sponsor are preservation of capital, a predictable, steady stream of cash flow, and potential capital appreciation. To further these points, I want to highlight one last item that is not shown on the screen, which is the master lease agreement. Typically, sponsors that represent UPREIT programs in market have a fixed rate master lease agreement, and the REIT has guaranteed the master lease payments to the underlying DST investors. These master lease agreements can range from 5 years to 20 years. The main difference between a 5-year or a 20-year master lease is the REIT is essentially on the hook for paying the DST investors cash flow payments for the life of the lease. The master lease agreement also helps smooth out the property valuation over the time frame and provides that predictable steady stream of cash flow to the underlying investor. However, since the investors will only likely be in the DST phase for 2.5 years or so, the master lease agreement is really used to mitigate the DST investors' underlying risk and to help keep the DST properties relatively stable. If the sponsor does elect to exercise the fair market value option and acquire the properties, the master lease agreement does go away post-transaction, post-UPREIT transaction. The fair market value option gives the REIT the right, but not the obligation to acquire the properties at fair market value and convert the DST investors' interest into operating partnership units of the REIT. Before the fair market value option is potentially exercised, the sponsor will go out and get an independent third-party appraisal, which will strike the potential transaction price. Dependent on the sponsor's master lease agreement and underlying properties, the investor may receive more operating partnership units than they had in beneficial interest in the DST if the properties were to appreciate. However, they could also end up with less OP units than they had in DST interest if the property was to depreciate. This is where sponsor selection is really important, but typically the goal for most sponsors is to have a master lease agreement in place that will keep the properties relatively stable during the DST phase and at the time of the fair market value option. If the sponsor elects to exercise the option and issue OP units to the DST investors, they are then transitioned to the underlying REIT's portfolio. So now, once the DST investors have been issued the OP units from the REIT, they have now made it to the final phase of the 1031-72 exchange solution. At this time, the client will start to get the benefits of diversification, and the cadence will change to a monthly distributions, monthly NAV, monthly statements, and then of course the annual tax form will be a federal K1 and state K1s for all the states that the REIT owns properties within. Typically, sponsors will provide a composite filing program to alleviate the burden of the investor filing each state K1 for a nominal fee. As I mentioned before, you typically will need to hold the OP units for a minimum of 1 year, but after that time, the client does have the ability to seek partial or full liquidity based off the REIT's repurchase program, which could also trigger a tax liability. If the client does not need any liquidity, then they have the option to hold the OP units in perpetuity and park those embedded gains in the REIT and use this type of solution for estate planning purposes. So now, before we get to the Q&A section, I do want to run through a few different client scenarios that are prime candidates for executing a 1031-721 exchange. So in this example, we're going to be talking through a client that is selling a business along with the real estate. And so in this case study, we have a farmer who's owned and operated a farm for the past 30 years. And essentially is going to be retiring and wants to sell the business along with the real estate for $6 million. The business is comprised of both real property, meaning farmland and personal residence, and personal property, tractors, farm equipment, and so forth. And the personal residence and the property does not qualify for a 1031 exchange, but the farmland does. The exchanger has a tax basis of $500,000 in the farmland, which appraised for $4 million, leaving the $2 million attributed to the personal residence and personal property. So this sale would, if they just sold it outright, would generate $3.5 million of capital gains and depreciation recapture, of course, if applicable, specific to the farmland. And so in this case, the exchanger can bifurcate the sale of the proceeds between the farmland and the non-qualifying assets, again, personal residence, personal property, and choose to execute a 1031 exchange of the farmland only to defer the tax on that portion of the sale. As you can see on the steps, so, again, first step one, before that property is sold, we're going to engage with that QI. Once the qualified intermediary is engaged with and is being utilized, then you can allocate the different properties between the real estate asset that you can actually defer the taxes on, and then the non-real estate assets. And then the last few steps, of course, at the time of the closing, the proceeds of the sale must go directly to the QI. And then ultimately, the QI will then transfer those proceeds over to the DST sponsor. One thing that I just will note too, just while we're on this page, is that typically a lot of investors, so if you've got a client that's already due diligencing properties before they sell the relinquished property, they don't have to take the entire 180 days to execute the exchange. They can definitely close within that 45-day window, and that will also satisfy the identification and just the exchange requirements. But in summary, not only just investors of real estate are ideal clients for this type of solution, but also business owners. So in this example, this is farmland, but also, again, if you have clients that are dentists or doctors, and not only have they, of course, they own the real estate, but they're also at that point where they're looking to retire, maybe sell their dentist practice, but along with that, they're going to sell the real estate. And so again, they will need to get an appraisal on the underlying real estate property, but that component can be 1031 exchanged and deferred taxes into a DST program like this. The next example that I think is really unique is called the top off. So I'm not going to kind of run through this. I'm going to go off a little bit off script right now with this part of it. But ultimately, if you've got a client let's say they have, again, a $2 million, they sold a property, or they've got a property for $2 million, and they ultimately still are at that point where they want to still be an active real estate investor. So they're not looking for a tax deferral exit just yet. But the property they found, let's say they sold a multifamily, they want to get into another multifamily property. The other multifamily property is 1.5 million. And to defer 100% of their taxes, they need to defer the entire 2 million component. And so right now they've got a situation where they've got still $500,000 left to defer for the ability to defer 100% of their taxes. In that scenario, that $500,000 portion can be easily attributable, and we can, the DST solutions like Invesco and others in market can kind of right size that approach, since we're selling off fractional interest of the trust to match the client's 1031 exchange needs. So that $500,000 portion can be a top off investment, and a DST solution can be utilized for that portion. And again, for the ability to defer all of the taxes, not just the 1.5 million portion of it. If they don't do anything to replace that $500,000, as you can see on the screen, that will be considered boot, which is a taxable event. And so the last case study, before I open it up to Q&A, that I just kind of want to run through is a DST investment with debt. And so in this example, you've got the goal, of course, is always to defer 100% of their taxes. So the investor currently owns an interest in a DST with an allocated property value of $4 million, comprised of an equity value of $2 million, an allocated debt value of $2 million. To defer 100% of those taxes, when they sell that property, there's going to essentially be $2 million of equity sitting with the QI. Now, for the ability to defer 100% of their taxes, they will need to replace the $2 million worth of debt. And so in this example, we've got two examples. Example one, all of the equity from the sale is reinvested and additional cash is contributed to purchase the precise amount of replacement property needed to defer all of the capital gains portion. So in other words, if you have a client that has $2 million of cash on hand, they could pay off the debt beforehand, or they can source up that debt and send it over to the QI for, again, the ability to defer 100% of your taxes. The second example is, again, you've got the all equity sale of the existing property is reinvested. And as part of the purchase of the replacement property, the investor assumes its pro rata share of 50% loan to value mortgage. So there are DST sponsors in market that can help clients that are looking to replace that debt portion. And so in this example, you've got the $2 million worth of equity that's already sitting with the QI. Again, you still need $2 million worth of debt or some sort of cash for the ability to defer 100% of your taxes. And so at this time, a DST sponsor is replacing that debt with debt of their own within the DST structure. And again, once you get that $4 million mark, you now have the ability to defer 100% of your taxes. So I know we covered a lot of materials today, and for those of you that are hearing about this solution for the first time, it can be a lot to take in all at once. So I just want to relay that my primary job here at Invesco is to help educate advisors and clients on how to execute a successful 1031 721 exchange, and would be happy to have any follow-up one-on-one conversations to answer any specific questions you may have. My contact information, I'll put that up on the next slide. So please don't hesitate to reach out. Now, I am happy to answer any questions that you all may have. But just as a reminder, I won't be able to talk about anything specific to what Invesco has and market, just given the diverse audience group. However, again, happy to answer any questions that you guys have specific to the 1031 721 exchange or anything that I've discussed today. And I'll just put this slide up too, but yeah, happy to take any questions. I don't know if there's any questions coming through.
Kyle, I think there's one in the chat.
Yeah, I'm just looking at it right now, actually. So, one of the questions, well, what are the points of attention to keep in mind if we're replacing one property for two or more properties of different types? Um, so again, so I'll just kind of take a step back. So again, so when you've got a $2 million property, and again, the replacement property has to be considered a like kind, but ultimately that whole 2 million can go into one properties or it can go into a multitude of properties. And so really just what to keep in mind is that again, the most important component is that the relinquished property value is and then was actually the replacement property value is equal to or greater than in value of the relinquished property. So as long as you can have, so for example, I'll give you an example. I'm helping a client out with a $75 million transaction, very, very large one. And the likelihood is that, we may be getting, 10 to $15 million worth of it. And so that's going to be split up between 6, 7, different sponsors. And so, that's on a large scale. But even we've seen on just kind of a smaller scale, there are clients that, even for just a $2 million property, maybe they diversify it 4 ways. So each sponsor gets $500,000. So I think the main point, again, is just to make sure that all the proceeds are invested if they are looking to have the ability to defer 100% of their taxes. But if there's any other kind of points that you want me to hit on that, please let me know. And then it looks like the next question I'm seeing is, what type of costs are involved with this type of exchange? And what level do these types of exchanges become viable? So costs are going to be unique. So this is one where I'll kind of just give you the broad strokes of the industry. And if you want to know a little bit more specifically, again, we can speak offline regarding Invesco. So there's essentially two different types of DST programs. Again, today I talked about 1031-721 exchanges or UPREITs. So these are all 1031s that you're ending up into a REIT on a tax-deferred basis. But there are DST programs that are standalone DSTs. So instead of going into a REIT, call it 2.5 years down the line, you're just going to be in that DST phase and you're going to be in there, call it, 5, 7, 10 plus years or so. And that's going to be focused a bit more on total returns. You're going to get a bit more upside potential on the standalone DST space relative to the UPREIT space, at least in the DST phase component of it. The reason I mention that is because the standalone DST market and the UPREIT market fees-wise are very different. Standalones, you can see fees ranging from 7 to 15, 18% on the upfront side. In the UPREIT space, you typically can see them, for RIAs, they can be as low as 2%, and they can typically still be as high as 8 to 9% in the UPREIT space. And that's just an upfront expense. So again, there is kind of a big range depending on the different types of investments. But specifically for the UPREIT solutions, that's what you're typically looking like on the upfront side. And again, that will be different depending on if you're a BD or an RIA, because there is the ability to charge an upfront sales commission. And typically RIAs will waive that commission, which actually gets kicked back to the form of a client with increased cash flows and more beneficial interest in the DST. And the second part of the question, what level do these types of exchanges become viable? So again, it's really just based off of the client. And so I think that right now we're at a time where we've got an aging demographic, a large amount of the owners that own real estate currently is the baby boomer generation. And they're really just looking at a point where, they're looking at their kids, and a lot of these kids are not looking to be landlords. Some of them might, but many may not want to inherit those underlying real estate properties. And so that same client, so because their kids don't want it, they want to sell the property, but they've held it for the last 20, 35 years or so, depreciated it down to zero. They've got a mass tax liability. And even over the last 4 years, we've seen what the value of real estate has really done and appreciation wise. And so that client wants to execute that 1031 exchange, but they don't want to just go into another property because, again, they don't want to be a landlord. And so they're at that point where they're looking for that tax deferral exit. And so that is an, kind of ideal, viable solution for that client that's looking for a place to primarily probably use this program as an estate planning purpose. Sell the property, defer the taxes, enjoy some income in the DST phase, maybe some NAV appreciation, but mostly just income. And then once they end up in the REIT, then they're going to get some more upside potential, total return profile, typically kind of in the 8 to 12% range, that kind of monthly income component. And again, the goal is just to really just defer that taxes in perpetuity. So that's just, again, I would say it's kind of your overarching theme of that's kind of one of your most ideal clients that would be viable for this type of solution. And those are the only two questions I see in the chat. Anything else from the group? And again, I'll just reiterate, again, it's definitely unique and sometimes a little bit more operationally intensive than other kind of solutions in the market. But this is something, again, where, I work day in and day out with advisors, clients, CPAs, QIs. Our goal here at Invesco is to help, ensure of a smooth, effective, kind of an efficient process to help your clients defer their tax. And so any other questions that come up, again, please don't hesitate to reach out to myself or to your respective consultant at Invesco. And again, I'm always happy to hop on and discuss in further detail. But I will say, Shannon and Megan, again, I really do appreciate you guys having me join the CFA of Minnesota, and hope to be back.